Some central banks have adopted negative interest rates, notably the ECB and Bank of Japan. What are the investment implications of this?
Yes, Noni, that's a great question. Actually, it's almost a little bit over a third of the global market cap in bond universe is underwater for developed markets under negative rates. But interestingly, the for investors that are home based in countries where rates are non-negative, and here's a counterintuitive take on it. Investing in international bonds with negative yields doesn't lock U.S. investors into negative rates. And the reason for that is that when you invest in an international bond, you have to factor in the currency that that takes basically to bring back that yield into your home currency, in this case into US dollars. Same for Australian investors into Aussie dollars. In finance and economics, this relationship between rates and currencies, they tend to offset each other. The more negative the yields are, the more the currency is expected to move in a direction to exactly offset and bring yields in parity with the US treasuries in this case. Otherwise, there would be equilibrating flows and arbitrage relationships. So the bottom line is investors should expect ex-ante yields that would be positively adjusting for the currency. That's not to say that investors don't get negative returns on a bond. The same whether it's in US treasuries or in a German bond or a Japanese government bond. That depends on how rates move and the different shocks to the economy. But the diversification benefits for that very same reasons are still there, even for those investing in international bonds.
Andrew, one of the questions we often hear from clients is, do you think we will experience negative rates here in the U.S.? What are your thoughts?
So I think the Fed would love to avoid negative rates at all costs. Whether they're going to be able to, we can't say one way or the other with absolute certainty. There's just too many other factors at play. What we have now is really a case study in Europe and Japan on the implications of negative interest rates. And it seems like to date, things are not playing out as policymakers may have hoped. You're not seeing the pickup in investment. You're not seeing a pickup in household leverage and the spending that may induce. So you're just not seeing the uptick that you may have hoped that would help drive their economies forward. In terms of the U.S., I think they're on much surer footing than our developed market compatriots. You have relatively strong growth here in the U.S., right, around 2%. You have a labor market that's approaching full employment, and you have inflation, whether it's by whatever measure, whether it's CPI, PCE, moving closer to that 2% target that the Fed has set for itself. That said, I think really the only way that the Fed is able to avoid negative interest rates, considering where rates are today, is if the U.S. economy is able to avoid recession. And economists are historically less than accurate about predicting recessions and when those might pop up. So in all likelihood, we will be able to avoid it, but we can't say with absolute certainty.
Clearly the Federal Reserve will try to avoid that, and we are much better shape fundamentally, labor market, economic performance-wise, than ECB, Bank of Japan, and a few other central banks that have pursued negative interest rates, which unsurprisingly hasn't gained much traction because the world had too much leverage before the GFC, and now hoping for those certain institutions to take on greater leverage in order to stimulate growth, I think is misplaced. So I don't think we'll see it from the Federal Reserve, but we could see long-term interest rates potentially drop below zero. I think it goes to giving on a cyclical basis how growth relative to financial crisis, lower the growth rates, the demand for high quality investment grade assets, that demand continues to rise. And so the relative value of U.S. Treasury securities, despite our level of debt in a highly indebted world, ironically, that demand continues to increase because it continues to show its ability to diversify portfolios, and Treasury bond prices tend to rise when stock prices are tending to fall. So I don't see that demand in near term changing. In a world where, at the margin, aging and potentially become a little more conservative, that's a tailwind for the demand for high quality fixed income. And ironically, in a high debt world, we actually have, you could argue, love to see more high quality debt, in terms of being able to invest in areas where, such as the U.S., reserve currency of the world, and in deep bond markets. So we've talked about this on and off for 3 or 4 years. So again, negative interest rates in the U.S. are clearly not our baseline, but should something happen, unfortunately, in the global economy that would even tip the U.S. economy into recession, the demand for high-quality fixed income assets, in my mind, would only drastically increase.